I want to talk a little bit about financial advice and how that side of the business works, because Vanguard is at least perceived to be exclusively a mutual fund company. So a lot of individuals are trying to figure out how to put a portfolio together. It's helpful to hear the number of funds that you would put into an account for an individual, and it's relatively small and should be manageable and a decision that an individual can make on their own. But yet many people come to their finances and say, please, Jack, just do it for me. Like, I'll literally give you the authority to make all transactions in my account. I don't want to know anything about it, which of course sets up a lot of people to be taken advantage of by financial advisors. So what do you think of the financial advice side of the decision-making process for an individual?
First, let me just take this, maybe you think it's kind of a nuance, but I got a letter from a shareholder the other day saying, you keep telling me you only need 3 or 4 funds, why do you have 170? And I took the simple example for him. We have like 60 bond funds, 60. Why is that? Well, we invented or created or developed a system of, you tell us the maturity, how much risk and how much income you want. So you get short, medium, and long, and also a couple of variations around that. And then in the municipal area, you only have the funds themselves, but you do in different states. And then we get some bond index funds, and we probably have 60 bond funds out there. So an investor either has to know and do the math. Should he be in municipal bonds or in taxable bonds? Very important decision. And right now, municipal bonds look very attractive simply on the numbers, those kind of numbers. And then you have to decide how you want to balance risk and return. Obviously, the higher yields, no matter how depressed they are in long bonds, but the greatest risk is there. And the lowest yield is in short, but the greatest principal stability is there. So those are decisions investors really have to think a little bit about. It's not just, you can buy the bond index to be sure, and that turns out to be an intermediate term bond fund, in fact. And that's perfectly satisfactory. But we kind of nuanced ourselves to death a little bit, and you should, in terms of taxable and tax exempt, deal with that issue. And I'd say, to simplify, most investors should be in tax exempt, just because they yield significantly more than treasuries, even before you take into account the tax exemption. So I think they're attractive, and maybe you want some treasuries there as your bulwark, and you can buy a treasury bond fund. And it gets to be a little nuanced. I think the interesting question is, if you want financial advice, how much should you pay for it? Let me give you an interesting little piece of math. I look at the stock market investment return as a 2% dividend yield at the present time, low but not nearly as low as the 1% we were, and a 5% earnings growth. That's a 7% investment return, and over the next 10 years I don't think it's going to go up because of higher PEs, or down because of lower PEs, not down much anyway, and so there won't be any speculative return by my reckoning. So we've got 7%. That's nominal. And so we go to real. And if we're lucky enough to get 2% inflation, that's 5. And a typical fund manager is taking 2. That's 3. And if you give a 1% to an investment advisor, that's a third of 3, and you're down to 2. And if you're a fund picker, you lose around 2% by jumping on the latest bandwagon. And 2% minus 2 is a number that I won't recalculate for your audience.
Well, it's a reminder of Warren Buffett saying that the financial services industry is an extractive.
Sure. The economists call it rent-seeking industry. Of course it is. It has to be. And it has to shrink. It has to get its costs down. The trading volume has to come down. And a lot of mutual funds are going to have to fight. They're going to be cash cows. The big mutual fund companies are fantabulously profitable. And they can't change what they're doing and do what we do, because they would not be profitable to their owners. Either financial conglomerates, or all those partners at Capital Group, or the Johnson family up at Fidelity. Their wealth is like $20 billion or something, putting the family all together. They've done great in this business. Whether their shareholders have done great is the question that interests me. That's where we should be focused. And the financial conglomerates, the same thing. They basically tried to destroy this industry. They own 30 of the 40 of the 50 largest fund groups are publicly held, and most of the 30 of them by financial conglomerates. And think about buying a fund that's run by a financial conglomerate. Why did they buy their way into this industry?
And why are there more funds?
The Golconda. They wanted to jump on the wealth bandwagon of managing money. And they will accomplish that whether by hook or by crook. If their return capital threshold is 15% and they pay $1 billion for a mutual fund company, they're going to have to take out $150 million a year. And it's easy. All kinds of things you can do to make it.